Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dan Bird. And I just realized I need to change my view. There we go. That's what I'm used to seeing. Mr. Dan Bird, how you doing, sir?
I'm doing pretty well. How about you?
I'm doing well. So it's the weekend. It's kind of our time to look back and also kind of look forward. Last week, we had a CPI reading. It came in hotter than expected, but the market did not behave the same way. And folks, again, Dan has his own playlist. Last week, we kind of went back and looked at what happened last time. Last time CPI was hot. Last time the Wall Street reacted one way. This week, CPI was hot. And at least from my standpoint, Wall Street did not act the same way. So what's going on, Mr. Bird?
Can never trust that Wall Street.
Damn those Wall Streeters.
They never do it. They never do what you think they're going to do.
That's surprisingly very true. So
you got to know how to figure out the internals, what's going on under the covers.
Yes, which is something you bring to us each week.
Right. Yeah. So let's see. Where shall we begin? Well, let me show my chart that I've shown every month after the CPI. And last time I said if it comes in really hot, it might not even make any sense anymore. So look at it.
So this is the last time we're looking at it because it came in really hot.
We'll see. We'll see. I have some comments to make about it.
Oh, cool. All right.
For next time, but let's see what we've got. First off, let me go here and show my newsletter if anyone's interested. I literally just sent it out.
Yeah, I was going to say I had not seen it this week, but folks, we're actually recording this on Saturday because I am not doing any videos tomorrow on Sunday. So yeah, I had not seen it yet. So very cool.
I just sent it out and I put a word of caution at the very end, even though we had a nice rally Friday. But we'll talk about that. But I do this every week on Saturdays. If anyone wants it, it's free. breakpointtrading@gmail.com. Just send me a note and I'll add you to the list. And if you get tired of seeing it, just let me know. I'll take you off the list. No big deal.
Yeah. It's funny you brought this up. This is something I talked about on my daily financial news, that chart in the lower left corner.
Right.
I think more and more people are going to talk about this, right? There's a headline number, which is the 9-1 we've referenced a couple of times, but then there's core, and core has been going down 4 months in a row. This is the fourth month. Trend is clear at this point. It was only down 0.1, but still going down. Right. And what we are going to see, and I said this earlier in the week, I think I said this Thursday, is we're going to start to see the largest gap between headline and core going back quite a ways, because again, food and gas are excluded from core because they are so volatile. If you go back to the 70s, why are they excluded? Because they're just too darn volatile.
Yeah, that's why they took it out, because otherwise they'd be doing rate hikes and rate reductions, every month.
Yeah.
Wouldn't make sense. I mean, they certainly look at headline, but they look at a lot of different things. We're gonna look at some of that today too, and why my CPI chart might not be time to throw it away yet.
Okay. All right. Well, I look forward to talking about that.
Yeah. So here it is. Here's the latest one with the 9.1 included in here. This is headline.
Yes.
Not core.
Yes.
Right. So in order for us to get to the 6.6 number that Fannie Mae projected for the year, it's a 12-month window. So since this one came in really hot, 9.1, basically what has to happen is these numbers have to go down by 20% over the next 3 months.
Dan, you could just throw this away. CPI
you don't want to keep looking at it just out of curiosity?
No, I don't mind. I'm just telling you that CPI, I've looked at CPI for quite a while now, and I'm willing to consider that this month, because I've told you last week, I think CPI is going to peak one of the next 3 months, which obviously means that this could be one of those 3. I'm willing to consider that, but to think that CPI is going to be anything lower than the 8s next month is almost irresponsible. It's far more sticky than that.
All right. Well, we'll see. I mean, the stickiest thing about it is rents.
And rents are going up, right? That's exactly right. owner's equivalent rent is delayed 6 month. Last month was the largest increase since 1983, and it ain't done yet. It is currently at 5.9, largest since 1983, and that goes up next month and next month and next month.
Right. Yeah, rents is the hardest part of it, really.
Mhm.
But well, we'll look
No,
at
it's
this.
fine. I love saying things because it's recorded now and people can make fun of me when I'm wrong. So it's okay. I don't mind.
Or give you kudos if you're right.
Yeah, it happens. It happens on occasion.
By the way, happy birthday tomorrow.
Yes, thank you. Yes,
That's why we're doing this on Saturday.
exactly. Yeah, I'm gonna be low key tomorrow.
Yeah. So anyway, I mean, we'll see what
Yeah,
happens.
no, I think it's interesting.
As these numbers keep coming in high,
Mhm.
I mean, the delta between the drops has to be much bigger. You notice in the last 3 months, I've got it stable,
Yeah.
4%.
Now so that's an interesting question because again, you could get to 4% lots of ways, right?
Right.
You happen to have 3 months of the same. That doesn't have to be that way.
Right.
Let me just think. Could we be at CPI, headline CPI of 4? Again, this will be a January report on December. Let me think.
Correct.
Let me think. No, there's no chance. We'll best case, I'm willing to guess right now, gun to head, like 5.354 CPI headline.
By the end.
Yeah. A January
What do you
report.
think what do you think the annual will be then?
Well, I don't know what the annual sits right now. So what have we got? 7.5 to 9.1, which probably puts the average of the 6 months probably what, like 8.4, 8.5? Well, that's just, and then you have 6 months going down. So
Actually, an interesting question. 12 months is here.
right. But what is the first 6 months
That's-
average?
Well, no, I'm talking about the whole year, 6.6 for the whole year.
No, I understand. But if you're going to ask me where we're going to average, I need to know where we're.
Well, so the whole thing is 79.6. 79.6 divided by 12 is
Should be 6.
it's 6.6 based on these numbers, but
I want to know the
you're
actual.
talking about this 12 months here.
Which are the actuals. No. Just January 22 to June. So 6 months
Oh,
actually.
so okay, gotcha.
So, okay. So we're average
6
8.3.
months, we got 49.9 divided by 6. We're averaging 8.3.
Yeah. So just so you know, if you look in the bottom right, it'll actually tell you that.
Yeah, I know, that's what I'm looking
Oh,
at.
okay.
But I had to divide by 6, so.
It's right there. Again, 49, 6,
Oh, yeah,
8.3.
8.3.
Yeah.
Good.
So let me think.
8.3.
So let's assume the next 6 months are under 9. I think that's okay to assume. Oof. I think they'll be under the average, so they're going to pull it down. My gut says will be 7.2 to 7.4 average for the year.
All right. Well, we'll see what happens.
So a little higher than 6.6. Okay. So that's CPI. Now let's look at the market. Because again, the market, again,
Well,
remember.
before we do that, let's
Okay.
let's stay on CPI for a second.
Oh, sure. Let's do it.
And this is something that I put on LinkedIn, but I'm going to actually show the current one
There you go.
just to give you a sense for the decline.
Mhm.
So one thing I learned, and I have not been able to verify this yet, but I heard it from a pretty good source,
Mhm.
is that energy is calculated from the 12th of the month.
Mhm.
So the June number is from June 12th to July 12th.
Yeah. It's mid-month.
I
for
haven't
sure.
I haven't confirmed that yet, so I'm not sure if that's really true. But if it is true, just look at these are all the commodities,
Mhm.
right? This isn't up to date, but I'll show you the up to date one in here in a second.
Yep.
But just look at the slope of the arrows,
Yeah.
basically from the middle of June on.
Mhm. Yeah.
All right, this is what the Fed is looking at right now.
So you think the Fed is looking at commodities?
I think they're looking at everything.
Okay. That's fair. Yep.
Commodities is one of the things that they look at.
I agree. I wasn't sure where you were going. Yeah. It's one of their input variables. Yes.
Right. They're not just looking at GDP, and they're not just looking at rents, and they're not just looking at CPI. They're looking at everything
Totally agree.
and how it's all going to be put together. So they're looking at something like this. I think they stay with 75 basis points.
I do too. Yeah. I
27.
believe so. I believe 75. I think
Mhm.
75 is a lock at this point, right? There was hope for 50 that left the building. There's been talk of 100. That's a overreaction. It'll be
Right.
75.
Right. I think so too. And I'll show you why here in a second, but let me show you the current state of these charts. So here's commodities. This is current as of Friday. I don't have the arrows drawn in, but you can kind of see it. It basically goes from rate of change, from the highest in the upper left to the lowest in the bottom right. Look at copper.
Yeah, people that don't know, copper is often called Dr. Copper because it has often been a sign of when a recession is coming.
Yeah, interestingly, I've seen a number of articles. I actually had a friend of mine who sent me an article saying, hey, copper is 100% predictor of a recession. When copper's in a bear market, when it's down 25%, it's 100% predictor of a bear market.
Okay.
So I said, okay, that's probably true. I said, how long after that does a recession happen?
Yeah.
And he goes, oh, I don't know.
There you go.
That wasn't in the article.
That wasn't it. Yeah.
So I went back.
Timing is important.
Went back and looked, and it's about 6 months.
Oh, so it's not bad. So 6 months. Okay.
Yeah, but even more importantly, and I didn't have this chart ready, but I can maybe for the next session, I'll try to find it.
Okay.
More importantly, what I discovered was there are many times when copper is down more than 25% and a recession doesn't happen.
Oh, so this blank statement's not true.
Yeah, well, the blank statement is true if you take it at its face value. And that's what the article said. It was an article from Fox Business.
Okay.
It said every single time copper is below 25%, drops 25%, there's a recession.
Okay.
What it didn't say was, oh, and by the way, there are other times when copper has dropped 25% that there is no recession.
So it's okay. I see the wordage. Okay.
Right.
Got it.
So if I had seen every single time copper went below 25% or dropped by 25%, there was a recession.
Right.
And it never dropped below 25% any other time.
Right.
Then I would put some credence in that statement.
Yeah.
But there are lots of times when it's dropped more than 25% and a recession never happened.
Yeah. And the other thing you got to remember is we're coming off a while. The thing that really makes my job hard as somebody who has studied the economy 30 years, the last 2 years are anything but normal.
Oh yeah.
So there is a lot of bananas things that are going to be one-time onlys, and old rule of thumbs are not going to apply.
Yeah, that's right. Well, you have to remember that. You have to keep it in context with the whole COVID thing.
It's just
because it's like a rubber band, right?
Yeah.
It stretches things way to the high side, and it's going to stretch things way to the other side. Eventually, things are going to get back to the mean.
It's going to be messy.
Eventually.
It's not.
All right. But other things to look at on here is let's look at food, because you mentioned food, right? So here's corn, and focus on the period from the middle of June on. All right. So here's food off a cliff.
Yep.
Or corn rather. Coffee.
Yep.
Off a cliff. Soybeans, way off a cliff. Wheat, way down.
Yeah.
Cotton for clothing.
Yeah.
Way down. Gasoline from the middle of June. Remember, energy is calculated from the 12th of the month. All right. So this is all going to go into that next CPI report.
Yeah, there's a lag. Let's be clear. But yeah, it certainly did not make this month. Yes.
It didn't make this month. Right. But it should make next month.
And I will say it certainly should make the month after, but yes, there's a lag.
Well, if they do calculate it from the 12th to the 12th, we've already passed the 12th. So if you look at just energy, look at WTIC oil here.
Yep.
Brent up here.
Yep.
From the 12th to the 12th. Gasoline from the 12th to the 12th.
Yeah, I guess what I'm saying is they're not looking at futures contracts, which these are. They're looking at the gas pump. And what I'm trying to say is there's a longer lag than.
No, you're right. No, there is a lag for sure.
Yeah.
But the Fed, I will position, is looking at futures.
Oh no, I agree. But CPI is not calculating.
They do see this trend, and they do know that inflation is coming down.
Okay.
So they're going to. That's why I say 75 instead of 100.
Agreed.
I think they're seeing this as well, and they're saying, look, 75, and I think that's going to prove to everybody that we did the right thing.
So I think we haven't agreed much on what the Fed's going to do. We both agree 75. Let's ask the trickier question.
Yeah.
Any thoughts on September?
September, that's a really good question. I am going to go out on a limb and say September could be 25 or nothing.
See, I knew you were going to go there, and that's why I love these conversations. I believe the Fed's going to come in with either 50 or 75 in September. So we disagree.
Okay, so I wasn't prepared with this chart, but I want to try to see if I can find it.
Okay.
Real quick, because.
Well, and let's just be clear why you look for this. The reason, so I knew where you were going to go. I would have guessed exactly what you said. The difference is I believe the Fed is communicating and clearly saying we can't make the mistakes of the 80s where we went, we thought we were there and we stopped. I believe the Fed's going to go one more time than the market expects. That's my standard.
That may be true. But let's look at it in the context of history.
Sure. I like it.
And this chart only goes back to the last 2 recessions. Mm-hmm. So 20 years, basically. Mm-hmm. But it includes the last 2 rate hikes.
Yep.
So I'll try to explain what this looks like. This red and green is it's the NASDAQ 100.
Okay.
So that's the NASDAQ going all the way up here and then coming down. Mm-hmm. The blue line is the Fed funds rate.
Yep.
So this shows you the hikes that they've done in the past, and it shows you where they are, right? Not quite where they are because it's not up to date for this month.
Right.
But the pink line at the top is where they are. They're at 1 3/4 right now.
Mm-hmm. Yeah, 1.5 to 1 3/4, correct.
Yeah, 1 3/4 is where they're at right now. And this pink line, you can just draw it across. Mm-hmm. So let's follow that back to the last 2 times. Well, first of all, before we do that, look at the red boxes. So the red boxes show is when the rate hikes begin in each of these cases, the rate hike begins and the market drops. See that?
Don't bet against the Fed. It's standard. Yep.
Right. Mm-hmm. So the rate hikes begin and the market drops. Mm-hmm. And interestingly, after about 6 months, the market has adapted to rate hikes.
Yeah.
And the market takes off.
Mm-hmm.
There and here. Now, this one back here was a secular bear market.
Okay.
So it wasn't quite as steep, but it was going up. Mm-hmm. This one here is the secular bull market that we're in right now.
Yep.
So it's much steeper. But the important thing to look at, and this is the current one, and about 6 months after the beginning of the rate hikes, the market starts going back up again.
Okay.
So it's built it in, it's adapted, it knows they're coming.
Yeah.
Rate hikes aren't a big issue any longer. Now there are other issues, but rate hikes may not be it.
Yeah, and this is why I believe Powell is being so adamant in telling the street what's coming. He wants to build this reputation that he's delivering what he's saying. He's not pulling Paul Volcker and raising on the weekends and surprising everybody.
Right. Yes. So if we follow this pink one across and we carry it over here to the last rate hike, which was 2018. In 2018, they actually raised too much and they see the market fell off. And then they stopped, they paused and they started lowering rates. And then COVID happened and rates dropped like a stone, right? So this is where they were at this exact same time. 1 3/4 was right here.
Okay.
Market was still going up.
Okay.
If you follow it back here to just before the 2008 recession, actually it's way back in 2004.
Oh, wow. Okay.
Is when they were at 1 3/4.
Okay.
Now this time they continued going up. It went up.
Man, it's hard to believe I was investing in a time when the Fed funds was 5%. I mean, people have mortgage rates.
5.5. Fed funds rate got to 5.5.
That's crazy. God, I have bad memory.
Okay.
Wow. Cool.
And they started dropping it just before the recession. But inside of this green box, the market kept going up. Even as the Fed kept raising, the market kept going up. Okay. Now these gray vertical dotted lines here are times when the market did have a little bit of a correction. inside of that rally.
Sure.
So I wanted to point out where the funds rate was when that happened. And in this case, this first one was, the rate was at 2.3%. And the next one was, rate was at 5%.
Yeah.
And over here, it was at 0.4.
Oh, geez.
Right?
Yep.
And then in 2018, when we had the trade war,
yep,
and we had that big drop off right there, it was at 1.4%.
Okay.
All right.
Uh-huh.
When we had a little bit of a pullback before the big pullback. Okay.
Yeah.
So right now we're at 1.75, and this is why, you know, we'll be at 2.5 after the next one.
Yeah, we both agree on that. Yes.
So we're going to be way up here, 2.5. That's why if inflation is showing that it's coming down and reset and earnings are not hitting and recession is in the cards, maybe be already in the recession, we're going to get that number on July 28th, right? Before the next meeting, which is until September.
Correct.
The Fed's going to have another opportunity to see another inflation report.
Yeah.
Actually, they're going to see two inflation reports.
They will see
right?
two. Correct.
So they may see inflation coming down dramatically, maybe not as much as the chart that I showed, 20% each month,
right?
But certainly coming down. So if they're already way up here, and let me just draw that line in at 2.5% right here. So let's say they are already there at 2.5%.
Yep.
And you can see where that is historically. That's above the one before COVID. And it's right about in the middle of this big one up here.
Yeah.
All right. So if they see inflation coming down, they see fears of recession coming, all of that, by the time they get to September,
yeah,
I don't think they're going to go 75.
No,
75 puts it way up here.
Yeah. So let's talk about this. I believe they're going to raise rates at every meeting the rest of the year. So there's 4. One's a lock. We both agree 75. So there's 3 left.
Okay.
Right. So I think they're going to raise 3 times. I think it'll be 50 a quarter. I think they're going to go to 3.25 to 3.5 by the end of the year.
So the next one will be 2.5.
Yeah. Then we'll be at 3.
You're going to go a full point by the end of the year.
Yes. In the final 3 meetings. Correct.
3.5.
3.25 to 3.5. It could be 25, 25, 25. It could be 50, 25, 25.
Right. So that puts it up here.
3.5.
About there.
Yeah. 3.5, 3.25. Yeah.
All right. So well above the last one.
Correct.
Certainly.
Yeah. I mean, so just to tie this out, right? I still think CPI is printing in the 6s. And if we've learned anything about inflation, you don't break 6% in CPI with a 3.5 funds rate, right? So, so that's kind of my, 2022 broken crystal ball.
That could be. So let's look at the market and see what that did.
Yeah.
This week.
Yeah.
This is basically 2 months worth.
Okay.
All right. So this is the market. This is the downtrend right here.
Yep. Those 2 big gap downs were the
last 2 big gap downs right here. The first one was the day before CPI. And then the next day was CPI. Gap down again the day after that. Kept on going down and hit the bottom.
Okay.
Right. Which we're calling the bottom.
You are calling the bottom.
At least for now.
The bottom for now.
Yeah. At least for now, unless it gets taken out.
Yeah. The bottom for now, and then it becomes,
Then we'll have a new bottom.
There you go. A new bottom.
All right.
Bottom square.
So the interesting thing to me, and I've been watching this all week. I have another view that shows me a 1-minute chart. I can actually watch the market as it's happening.
Yeah.
Even as the market was coming down right here, look at the 10-year treasury.
Dude, that's bananas. I actually had a mortgage guy on me with the day this reported.
Right.
Again, let's think about this. CPI surprises to the upside. It's the hottest in 40 years.
Yeah, these vertical blue lines is where the CPI was reported.
We pulled up.
Here's 8.6.
We pulled up the mortgage chart. Mortgage rates got better.
Yeah.
How the hell is that supposed to happen?
Exactly.
Wild craziness.
So why? So what? Your mortgage guy? What did he say? Why is it happening?
He basically says more and more people see a recession. They think the Fed's gone too far and people are piling into treasuries.
Yeah, the Fed has not gone too far.
Well,
I've heard that as well. I just showed you that chart. This one here.
they haven't gone too
Right,
far.
here's the pink line. The Fed has not gone too far.
Totally agree. But that's what the people are acting like.
I know that's what people are acting like. But historically, we are still at very low rates.
Oh, we are below
1 3/4. We are still historically at low rates.
Dude, we're accommodative at 1 3/4. Let's just say what it is. We are not restricted.
That's exactly right.
We are accommodative.
I mean, we didn't even get back to 1 3/4 until halfway through the financial crisis.
Exactly.
Look at that.
We're accommodative.
We didn't even get back there. We didn't get back there until 4 or 5 months before the COVID crash.
Exactly.
Now, the next rate hike, we're going to be up here,
mm-hmm.
right? 2.5%.
Mm-hmm.
That is a reasonable Fed funds rate. It may not be enough to break inflation.
Yeah, that might be reasonable. Neutral.
That's right. That's
not
a neutral rate.
To me, so it's not restricted.
The Fed has not gone too far.
I agree.
Not yet.
I agree.
Well, they usually do go too far.
I agree with that also. They
haven't yet.
I agree. Right. The blend instrument makes it goes too far.
So let's talk about this 10-year yield. I mean, I just think it's fascinating.
It was wild. I looked at it for like 4. I couldn't. It's just wild.
I love seeing it go down. I mean, on my chart, I've got on one screen, I've got the S&P.
Yeah. 1
minute chart.
Yeah.
And on two of the other ones on the other side of the VIX.
Yeah.
And the 10-year Treasury.
Yeah, it was wild.
And again, I love seeing the S&P going up while the other two go down.
Of course you do.
You can see that right here.
Yeah. Oh, no, I know. It was wild. Again, it spiked pre-market because I think it came out at 6 a.m., which is pre-market. So it had a little kind of gut reaction. But by the time the market was open, it was already going the other way. It was wild.
Right. So this vertical line is when the 9.1 came out. Mm-hmm. This is the open on the 13th.
Yep.
From the time that came out, the 10-year spiked.
Yep.
But it did not spike above this trend line.
It did not. No.
And it continued down.
That's wild.
As did the VIX, which is the fear index.
Yeah.
Right?
So again, this is screaming. Smart money is calling 9.1 peak inflation.
Not only that. So think about this for a second. This is below 3%.
Yeah.
Why the hell would bond buyers be buying bonds, 10-year bonds? Mm-hmm. Why would they be buying long-term 10-year bonds, pushing the rate to below 3%?
Yeah. If
inflation is at 9% and going up, why would they do that?
They wouldn't. They believe it. They believe it's
That's
going
right.
the other way.
And I think bond buyers are smarter than equity buyers.
I agree. Yes.
So they do not believe, and I'll say it again, they do not believe that inflation is going to stay high for very long.
I agree.
And this is another thing that the Fed will look at.
Yeah, I agree they will. Yes.
All right. So the market started going up. We had a really nice rally. It actually got over the 50-day in this chart.
Oh, interesting.
But we didn't get back up to the high up here. So we're trading in this channel right here, these two pink lines. We're trading right between this channel, and earnings is coming, starting hot and heavy next week.
Yeah, starting Monday. Yeah, I did a list of earnings. Yeah,
I think we probably on Monday may get to the top of this channel.
Okay.
And then as earnings start, we may head back down again.
Yeah.
Now
go ahead.
Let's look at the most important chart that I have in my arsenal.
I like it.
And I put a link to this in my newsletter. So people can put it on their favorites and they can look at it. They can't change anything. And anything that I change will appear there.
Oh, cool.
So they can continue to watch it. But this is the sustainability ratios. Mm-hmm. So I've explained this before, and I'll do it very quickly again. All you need to look at is what happened in December. The market continued to make new highs. It hit all-time highs right here between these two green lines. That's December. Market hit all-time highs. However, starting in November, this is where you look at the internals. This is where you see what the big institutions are doing. the ones that are doing things under the covers, that don't want you as retail traders to see it or know about it, right? Because they can't make moves in one day or 1 week or even a month. It takes them a long time to move their money, to change direction. So starting back in November, they started rotating out of discretionary or aggressive and into staples or defensive. They started making that rotation even as the market was making new highs. So all the retail buyers are saying, we're going to the moon. And the smart money was moving their money over into defensive areas. All right, this is the NASDAQ versus the S&P, NASDAQ 100 versus the S&P 100. This is Russell growth versus value, big cap growth versus value. This is small cap growth versus value. All of these were trending lower as the market was trending higher. That's the signal. That's how you know. That's how you can follow these big institutions to see what they're doing. Now, again, they can't make that move in just 1 month. So they continued rotating out all the way through. You know, each of these vertical lines is where we hit the lows. All right. Each time we hit a new low, they were still rotating out of growth areas or tech and into value. Until we got to here. When the market, after that last CPI report, you can see those gaps right there. The last CPI report, the market sold off big time, went all the way down here to what we're calling the bottom, at least for now. Right? But what happened with the institutions? What were they doing? Well, discretionary versus staples started going up. It came back down and hit the low again. And I took this green line off at that point, but now it's going back up again. And remember, we just had another bad CPI, a worse CPI report. A worse one. But look what's happened with NASDAQ and S&P. Look what's happened with tech. I mean, I don't even think it's hidden anymore. Everybody saw the rotation into tech last week.
Clearly.
Right? Look how much this line has accelerated here, even as we hit that bad 9.1 inflation report. And all of these sustainability ratios continue to go up. Now, I am not going to concede that this is the bottom until I see these sustainability ratios break this support line down here. Until I see that institutions are rotating back to value or back to defensive, until I see that they are doing that, I'm not going to concede that this was the bottom.
So let's just put some money up, right? So I think 2 or 3 weeks ago, we talked about you were starting to nibble. I think maybe 30% you had put to work on some positions. Are you still at that number? Did you put more to work? Where are you kind of?
I put more to work, and they were working beautifully this week.
Okay. All right. So are you 50%?
Mostly in tech, by the way.
50, 60%? What do we?
I would say
not fully deployed.
Not fully deployed. I would say probably 60%.
All right. So you've doubled. You put more cash to work. Okay. Because of this most important chart.
Because of this right here. Yep.
I like
and that. I mean, we still have to get through this where the circle is.
Right.
This is really, really critical. And in order to confirm that we have started a new uptrend, we have to get to a new high.
Okay.
A new higher high. So we have to get to above 39.50.
Okay.
Which basically means we have to get through this 50-day moving average right here.
Got it.
So we got to get to above 39.50. And then we probably will come back down. When we come back down, we need to stop coming down above the 37.50.
Okay.
So we have to make a new high and a new low, a higher high
low and a higher
low.
I like it.
In order to confirm that the uptrend is confirmed, basically.
Okay.
If we can't do that, then we are still in this downtrend line. You can see the downtrend I've drawn right there.
Yes.
So we need to get above 39.50 on the upside, and we need to stay above 37.50 on the downside.
This is so awesome. And again, I want to highlight, you've put this chart out there. You put the link in your chart so people could get your newsletter.
In my newsletter, they can save it to their favorites and look at it anytime that they want. So they can see what the institutions are doing as well.
Very cool.
This is kind of a secret.
Yeah, I love it. This is going to be important because earnings, like you say, start hard and heavy. We had the big banks last week. A lot more stuff coming,
Here's-
much broader.
Here's the VIX. Last week I said the VIX started going back up again, but look at that, it reversed and started going back down again.
I think it's wild. You get a 9-1 and the VIX rolls over. It's crazy.
Right.
It's awesome.
Yeah. Here's this is my head and shoulders chart that I've showed before. You can see the channel that we're in.
Mhm.
By the way, for those who know technical analysis, this is called a bullish wedge.
Hmm.
You can see the bottom down here and the top down here.
Mhm.
They're coming down and they're getting narrower and narrower.
Oh, tighter and tighter. Cool. All right.
This is typically in technical analysis, it's called a bullish wedge,
Okay.
and they normally break to the upside.
Right.
Now you don't know when, because there's still a lot of time to go before they actually meet down here.
Right.
So if it breaks out, next week and gets above 39.50 and continues even higher, then it will break this wedge.
Nice. Okay.
But you can see where we are right now so far.
I like it.
What else? This is the long term since 2009. That's the channel that we're in.
Mhm.
You can see every time. Remember, this is a secular bull market,
Mhm.
and all of these circles here are cyclical bear markets. It's when in this secular bull, the market came back to the center line
Mhm.
and went back up again.
Yeah.
Look where we are right now.
Yeah.
Right at the center line. And this is the long-term one that I've showed before. Again, these are the cyclical bear markets, down 21%, down 15, down 20, down 35 during COVID. Right now, we're only down almost 25%. So even though it looks really bad, because we went up so far, it looks worse than 25%. I mean, that's, I'm almost on par with these other two here.
Yeah.
So this is where, we hope we'll go back up, but we could get down to the 50%, 3,500. We could get down to the 38% level, which is 3,200.
Yeah.
The COVID high was 3,400. So all of these levels right here are still in play if we can't make that higher high and higher low.
Yeah, and this is an important week because, again, what I have often said, and again, I'm wrong all the time about stocks. That's why you and I are talking, because it's not my forte. Feels like we've had more earnings compression, right? We've gone from multiples of 24 to 16. It still feels like the E is wrong, earnings.
Yeah, I know. That's what we're heading into, and that's the biggest risk. This is something I put in my newsletter, this chart right here. Now, earnings estimates have come down by 5%.
Yeah. That's amazing. In 1 week, I was just
1 week. Yeah.
I was just beating up Wall Streeters for not doing their job. And look at that. We got 5% in
First week of July, analysts drastically cut earnings.
Drastically.
5%, but you can see these are the earnings cuts so far. You can see it's
more coming.
It's really not even close to the linear trend.
Yep.
Here.
Yeah. No,
so, I mean, it's a big risk.
Yeah, I agree.
Going into the next month.
Yeah.
Is a huge risk. And I said it at the very end of my newsletter. I said, you got to be careful. We need to get through this. We need to see that higher high and higher low. But this is a major resistance level. We bounced off of it twice already.
Yep.
And we could bounce off of it again. And if we do, it's going to probably be Monday or Tuesday.
Right.
And then we head back down either to the bottom or inside this channel line around 37.50. We'll see.
It's going to be a lot of fun. These next couple of weeks are going to be interesting. I think in the next 3 weeks, like 75% of the S&P 500 reports. So we're going to know inside a month.
Yeah. And in addition to that, we've got a Fed hike.
Yes.
And we've got a GDP report.
Yes. Yeah. It's going to be
both
wild.
of those are within the next 3 weeks as well.
Yeah. Very cool. Well, Dan,
so, there's a lot of case to be made for the bear case here as well.
I would just call it for guys like me, it's okay to sit in cash. I'm okay. Yeah. I'm just waiting.
Yeah, I agree. And even the moves that I made, I mean, I bought NVIDIA and I bought UCTT, which is also a chip stock. Both of those are up nicely, 6% and 4% in a week.
Yeah.
But I'll have very tight stops on those.
Yeah, so. You size your position, stops. Again, watch his playlist. Some of his very early videos is showing him how to use his risk calculator. You don't go blind. Have stops.
Right. Yeah, and I wouldn't be surprised if I'm stopped out of all of my positions next week.
And that's okay. That's why you have them.
And that's okay. Even if I make a little bit, 1 or 2%, in a week or so, I'm fine with that.
There you go.
And I'll just wait for it to come back down and start back up again.
There you go. Well, Dan, I appreciate you doing this. This is going to be fun. This is going to be a couple of really fun weeks to watch this stuff in action. Can you show your newsletter one more time?
Yep. The next session that we do, we talked about repairing a broken trade last time, and I'll show you what the results of that have been.
Absolutely. So again, folks, if you're listening on the podcast, it is breakpointtrading@gmail.com. Send them a link, get on the list, watch it. Worst case, you laugh at some cartoons. Best case, you look at this and you'll learn a little bit more. I look at it every week. Thanks, buddy. I appreciate it.
All right, you bet.